it's full screen now. Yes.
Already. Great. So thank you, Mugdha, Dr. Premnath, Shruti, and the Venture Center team having.
Ameya, probably a low bandwidth. Your
Mugdha, I'm back. Is the audio okay?
Yes, everything fine, but your screen has stopped sharing.
Okay. For some reason, Zoom is giving some error message. I don't know why, but anyway.
Do you want to switch off your video? You just compensate for the bandwidth?
No, not a bandwidth issue. Anyway, let me share the screen again. Is the screen visible now?
Yeah, it is loading at our end. Yeah, screen is visible except for the full screen.
Sure. All right. So good evening, everyone, and welcome to this part 2 of the session around compensation through share-based transactions. And I think some of you may have joined this session and did not attend the last session. Some of you are continuing. So just to set the context, employee stock option program, or ESOPs, is an effective way to compensate a good talent and attract a good talent and retain through a non-cash way. And we discussed during last session the entire sort of process of ESOP, the act of granting of the options, the process of vesting, and at the end of vesting, employee can exercise these options, and then those options are sold eventually, or monetized. So this is a typical life cycle. There are several sort of commercial and cash flow and softer aspects with each of these decisions that one has to consider. We also touched upon the taxation aspect, where in India the taxation happens at that point in time of exercise of the option, which means that when an option is converted into share and employee exercises these shares pursuant to options, at that point in time, the salary taxation and TDS comes into picture. And then there is, of course, a conundrum on when do you actually make a decision to exercise, because it comes with a tax cost and a cash flow implication as well. So this is where we discussed last time. Over next 45 minutes today, we will continue certain further aspects on strategies and best practices around share-based remuneration. Like last time, I would recommend and request all of you to, or to the listeners, to put your questions in the chat box as the session is on, and at the right time, I will deal with those questions then and there itself if the question is relevant. And feel free to, of course, ask as many questions or scenarios as you can. So with this context, let me sort of begin today's slides. Like I said, we are building on to where we left last time. We are planning to discuss some 6 or 7 specific scenarios, stroke case studies that I have seen typically being applied in case of ESOP. There were some questions around standard templates for ESOP agreements. I Googled it and there are many options, so I don't have any particular recommendation around which one to choose. Most there are quite a few options available that provide the standard template. That was one open question. There are a couple of interesting propositions also, like ESOP Direct, a Pune-based company, which provides a technology solution and the entire sort of manages the life cycle around ESOP. That's again one recommendation. We know some of the folks over there. That's why I'm sort of suggesting. These were some open questions from the audience last time. I thought I'll clarify them before we move on. We left last session at the time, discussing the concept of share-based compensation to non-employees. As we said, that company law puts certain limits on who are eligible for ESOP, and the first box that you see on the slide, uh, there is a restriction under the company law. ESOPs can be given to permanent employee, directors, and employees of holding or subsidiary companies. And then there is, of course, a limit on uh, is who cannot get ESOPs. So promoter group, director holding more than 10% equity, they are not eligible under the company law to receive ESOPs. So you will sort of observe that it's only the directors holding less than 10% and employees who are eligible for ESOP. The company law doesn't permit issue of ESOPs to non-employees. So if, for example, I'm a consultant giving advisory on, say, tech strategy of the company or a marketing strategy of the company, I'm not an employee. Uh, how does company sort of reward me through a share-based payment? And if I have to give a one-line response, today the rules are quite complex and mostly tax inefficient. If I were to put it, so effectively, one cannot allot shares to a non-employee through an ESOP route. Those shares will have to be awarded through under the company law, what we call as a preferential allotment route. In other words, a company will have to value the services that a person is providing, and in lieu of that service, there are shares being issued. This is similar to the concept of ESOP that we discussed. Now, one can, like I said, compensate or issue shares for the services provided. However, the it is highly tax inefficient, and there are two sort of immediate consequences that become relevant. Consequence one is that the TDS becomes immediately applicable on the fair value of the shares or the fair value of the services. Unlike a situation in case of ESOP where your taxation event is postponed up to the point of exercise of the option. So this is one big implication, that tax becomes applicable immediately when you allot options or shares at a fair value, and this is an income tax. Second, by the definition, these professionals or people to whom you are issuing ESOPs, they are not employees. So there is no employer and an employee relationship with them or amongst between the employer and that person, which means it is a consideration for services. And the moment it is a service contract, GST becomes applicable. And as you know, by and large, GST is a 18% rate. So that again becomes a cost on the startup, especially if startup is not able to immediately utilize the GST cost. So these are the two sort of key considerations, and mostly tax becomes a very important factor and makes it sort of non-starter. So is there a sort of easy sort of answer or approach to deal with this? Answer is no. There are some alternate options which I have put down on the screen, and the first box is we discuss the company law limitations. So what should company do? What could company do? I think one easy approach would be, or not easy, one possible approach would be to issue these share-based sort of compensation, introduce them at a very early stage of the company when the value is not quite large. So the tax consequence is not sort of material. I think that's easier said than done, but that's one approach. So earlier the better, I think, is one approach. Of course, this is commercially, you will realize several scenarios at a later stage. So I have put down some alternate options over here. I must sort of add a caveat that uh, don't just take these options on the face value. They may or may not work in all the situations. But these are some of the approaches to achieve the same result, that you want to reward people who've been with the company and providing services in a slightly more friendly manner. Commercially, there could be different outcomes. So, one, as I said, is a preferential allotment at a face value or at a lower sort of price. And here, valuation report becomes a very, very important point. So if there is no external valuation that has been carried out, uh, and if there is a flexibility, can the fair value of the shares be kept at a minimum possible way? Of course, here, if some report external benchmark has already gone out, it becomes that much more difficult. The second issue I have seen is a right-based approach, where rights issue is made to the founders uh, at a NAV, not a fair value, at a NAV, and then those rights are assigned by the founder to the individual who should sort of eventually receive the shares. Uh, these are again, like I said, we have to create a commercial rationale over here. There are some tax costs, mind you, again over here also. However, with a NAV based approach arising in a rights issue, I think the tax cost could be sort of minimized to a great extent. Of course, rights issue, if there are external investors, they typically do not agree. So how your cap table construct is also one of the important factor to do a rights issue. Uh, I had sort of advised somebody about a year ago, and the founder's requirement was that the company was into operation 15 years. Uh, and the founder said that they may do a strategic transaction in the next 3 years. Am I audible? I received an error message, so just rechecking.
No, you are very much audible. No
Okay,
problem.
okay. Uh, so I was sharing a instance where the founder wanted to give shares or include some people who have stood with the founder and the company for last 15 years before they go into a larger strategic transaction. Now, here it's not even a case where they are rendering a specific service. Founder said that, for example, 0.5% I want to allocate to these 10 people who've been with us through the ups and downs of our life and company's life. So how do we sort of remunerate? Now here, because it was while there are, of course, they must have contributed to the company, but they were also, in a sense, within the close influence or close circle, and I would put them as friends and family bucket. Uh, we created sort of a option of LLP of these holders, and that LLP sort of becoming shareholder, or a gift of shares also. Again, like I said, these are some of the approaches. If the value of the shares is has already sort of increased, uh, there are still tax consequences. Like I said, to the extent of the fair value, the key is therefore to reduce the fair value or control the fair value. And of course, there has to be a strong commercial rationale to make it happen. Uh, so, uh, so Rajul, to answer your question, in the case study that I mentioned, they were not employees, and therefore, of course, ESOP was not given. If they were employees, we could have given an ESOP. In fact, it was not even a case where they were providing a specific service. It was a it was a it was promoter's gesture to sort of make sure that these people participate in the value creation once the larger strategic transaction happens. So it was even more sort of nuanced view of the promoter on allotting these shares. So these are some approaches around rewarding a non-employee. I think two takeaways for founder so who are here, start thinking about this a bit early in the day. I think that's the key. Or start at least thinking of an approach for rewarding non-employee if you sort of anticipate and put in a structure at an early stage of the company, because later on then it becomes a very expensive proposition to give shares to non-employees. If there are any questions from anyone in the audience, please put them in the chat box. Uh, I'll move on to the next aspect, which is ESOP relaxation available to the startups. On the first point, the non-employee, again, if you have any questions, any case, any scenarios that come to your mind, feel free to put them in the chat box. We can deal with them later as well. I want to move to the next aspect of ESOP relaxation uh, available to the startups. Now, uh, we discussed during last session in the last 15 minutes all these limitations under the company law and even tax consequence in the under the tax law as well. Now, if you are a registered startup, and I'm sure all of you know what it takes to be a registered startup with a DPIIT. So if you are a registered startup, there's a company law exemption that is available. Uh, a startup can actually grant ESOP even to the promoters as well as directors. So this is a very, very important sort of relaxation that has been provided. So promoters and directors of registered startup can receive ESOP as well. Uh, so 2 points: if your company is not registered, your startup is not registered yet, consider registering it under the startup scheme. This is one more advantage of being registered under the startup scheme. That's point one. Point two, and this was again a situation that we looked at one of the client situation. As you know, the startup registration or recognition is available up to certain monetary or turnover thresholds, and there is a outer period of 10 years, which is also applicable. Now, in one of our client situations, uh, promoter investors and promoters agreed that promoters will be rewarded through the ESOP, but the 10-year period had already expired for that company and they were no more regarded as a startup. In that case, then again, one has to fall back to the options that we discussed in the previous slide on rewarding non-employees. One has to sort of consider similar approaches over there as well. So this is a very important relaxation to a registered startup, that there the founders and the promoters and directors can also receive ESOPs. Uh, that's point one. Let's move to the tax relaxation. Uh, as I mentioned earlier, under the tax law, uh, employer has to do the TDS and employee has to pay the tax at the time of exercise of the shares. Now, again, exercise of the shares, it still means that there is no cash or a liquidity either with the company and definitely not with an employee. So a question often comes up that at the time of exercise, if there's a tax, who would pay that tax, because it's a cash outflow. And this often is always a challenge in case of startups. For a startup, there's a tax relaxation that this TDS or tax can be uh, deferred and paid at earliest of the three situations: 5 years from the allotment, or sale of shares, or termination of employment. So effectively, there is a easing provided on the cash flow side. So even if you exercise the ESOP, the TDS and the tax gets deferred to the liquidity event or the termination, or 5 years, which is the outer limit. Either of whichever of these three happens earlier, at that moment the tax can be deposited or TDS can be done. So this is again a very important relaxation given to a startup under the income tax law. But I must sort of add a very important point here. To be eligible for this tax relaxation, the startup has to be registered under Section 80IAC of the tax law. To make it simple, uh, obtaining a startup registrations with DPIT is relatively easy. I mean, there are objective conditions, you meet them, you file an online form, and more or less you get the startup registration relatively easily. There is a phase two of the startup registration to get a tax approval, and this approval also entails the income tax holiday to that startup. This approval requires certain conditions to be met. These are slightly subjective tests, and such a startup needs to be approved by an interministerial committee or a board set up. And often many startups do not cross that threshold. So this ESOP relaxation is available only to a ATIAC approved startup. So the first box, company law, it's applicable. Relaxation is available to all the startups. The second one, you need to sort of comply and be approved for tax purposes as well. So there's an additional process which actually again very few companies qualify, very few startups sort of qualify for this relaxation. So these are the important relaxations available to a company registered as a startup. Uh, I want to also discuss about Swiggy's news around ESOP. Coincidentally, it happened during last 7 days. I'll touch upon that, but let me sort of deal with some of the questions that have come in the chat box. They are related to this slide as well as the earlier slide, and I'll deal with both. The question is, if you are rewarding non-employee, what is the tax implication? As I mentioned, tax is applicable immediately at the time of granting of that instrument and at a full rate of tax. Uh, what is a instrument most suitable for giving equity to mentors? Um, I would say again, a share or a share equivalent is the right way, because only then you are rewarding a mentor, and mentor will be incentivized also to work with the founder. And then for that to happen, I think allotting the share to the mentor at a very early stage will be necessary. Otherwise, at a later stage, allotting will become a problem, and you will have to, like I said, look at plan B, which is not very which is not very easy sort of to implement as well. So, Mehul, to answer your question, it has to be if it is a equity driven, start early, or else uh, some of the plan B options that I shared on the earlier slide may have to be sort of looked at. There are a few more questions. I'm dealing with them as well. There's a question on what happens if an employee quits after receiving the ESOPs. So usually I have seen that most of the ESOP scheme provide an exit clause that if an employee quits before the vesting happens, then those shares shall lapse. However, once an employee becomes a shareholder and then the employee is quitting, uh, if you don't provide anything in the scheme, employee is a shareholder and he will be entitled to an upside. What you could possibly do, and this is where the drafting of the scheme becomes very important, is that the promoters can keep a drag along right on shares allotted through ESOP. And maybe if an employee has quit, uh, uh, maybe put a discount. For example, if employees has quit, he will get only 50% of the fair value, something like that, through a drag along right, just to make sure that founder is able to retain the control over the process, but at the same time make it fair for the employee, because otherwise the employee will also sort of not be motivated to work with the startup. Is there any other registration other than DPIT for startup? Proper, no. For income tax purpose, there is additional approval which is needed, which is what is required for tax relaxation as well. There are very specific questions. It might not be possible to deal with a very specific scenario with years and numbers and all of that. So my request is if you can keep your questions slightly at a conceptual level, it will benefit all of us. For a very specific question, maybe we can uh, maybe we can.
Maybe we can reach out to you separately. So they can feel free to write to us and we can connect you to Ameya separately.
Sure. Thank you. So let me sort of move to the next sort of aspect is holding subsidiary relationship as well. Um, 1 minute. Huh? Yeah. So at times in the companies there is like a holding company and various subsidiaries within the holding company. So let's say you are offering a product and a service. So you create a holding company and you create a product company which is separate and a services company separate. Or in many times, many fintech models I've seen there is a holding company and underneath there is a subsidiary one which is a regulated entity is approved by RBI and entity two which is actually carrying out the non-regulated activity. Both are interconnected and therefore there's a holding company on top of it. In all such situation, again, how sort of ESOP works. Now you can't have ESOP by each of these three companies. So typically a holding company itself frames a ESOP scheme which is offered to employees of the holding company as well as to the employees of the subsidiary companies, and this is permissible under the company law as well, that subsidiaries employees are also eligible to receive ESOPs from the holding company. Again, you can keep this context in mind if your structure is sort of getting expanded at a later stage. Um, the income tax implication, as far as employee is concerned, there is no change. The same consequence sort of continue. That employee will be required to pay tax at the time of exercise. The employer is required to deduct TDS at the time of exercise. There are two sort of the next two sub bullets are slightly heavy accounting sort of implications. I'll just touch upon it, but maybe you can, I'm sure your own CA will also advise you, but there's an accounting implication. So, for example, ESOP is issued by the holding company to the employees of the subsidiary company. Now, here, the subsidiary company's cost base must factor the ESOPs which are issued by the holding company, and therefore some sort of a cross charge from the holding company to the subsidiary company needs to come. In simple terms, wherever the employee is providing the service, the proportionate cost should sit into that legal entity. I think that's a simple principle that becomes relevant in case of ESOPs which are issued by a holding company. Uh, so all I wanted to sort of clarify is that ESOPs could also be issued in this sort of manner. I'm going back to the earlier slide once again, and just wanted to cover the situation around Swiggy's ESOPs. Uh, I think our session happened on last Tuesday, but I think on last Wednesday or Thursday, I'm sure many of you would have read about Swiggy's forthcoming IPO. And before the IPO, Swiggy has filed a prospectus with SEBI, a draft prospectus, and uh, the headline was all over that founder so and so is allotted shares worth so and so million. So it looked very interesting, and even my eyes sort of popped up as to I told folks at Tuesday session that founders cannot receive ESOP, so how did they sort of manage it? So the logical answer could be that are they a registered startup or is there any other sort of angle? So I read the draft prospectus. Interestingly, none of the founders hold beyond 10% in Swiggy. That's point one. And point two, they have taken a view that there is no promoter group. All are professional investors in that sense. Now, this is a SEBI legal view, and uh, it's not part of today's discussion. But I think with these two sort of handles, Swiggy probably took a view that these ESOPs therefore are not hit by the company law limitations that we sort of discussed. Swiggy's definitely crossed the thresholds of being registered as a startup. I mean, it's beyond those thresholds, so therefore it would not be considered as a registered startup. But I think they took this legal interpretation to make sure or to issue these ESOPs to the founders. I mean, founders in a not in a legalistic way, but in a commercial way. I think that's one sort of interesting update during last 1 week that I picked up. I thought I should share with the group here. We'll move to the next aspect is very briefly from a completeness point of view, cross-border ESOPs. Now, we have seen situations where founders set up companies in India, and then those companies sort of grow, and you create a subsidiary in UAE, you create a subsidiary in US, you hire people in US, for example, to do your sales, product sales. What happens to such employees who are working in the overseas jurisdictions? Can those also participate in the ESOP issued by the founder by the Indian company? So, the simple answer is yes. Company law as well as FEMA, which is the Foreign Exchange Management Act, permits ESOP between cross-border holding subsidiary situations. Similarly, if you are an employee working for a foreign company and you become entitled to ESOPs issued by a foreign company, you can remit the money for exercise price under FEMA. Otherwise, as you know, FEMA has got this limitation of $250,000 of a upper limit for remittance for various transactions. Also, capital account transactions, there's a limit. But if it is part of the ESOP, again, this FEMA allows an employee, both inbound as well as outbound situations, to participate in the ESOP as well. More or less, tax remains the same, but because it's a cross-border transaction, transfer pricing becomes relevant. GST at times has been an issue that GST authorities say that this reimbursement, be paid by the is subject to, I mean, this cross-border recharge is subject to GST, but I think most of the tribunals have held that it is out of GST because it is for consideration for services. So to summarize, in a cross-border situation between a foreign parent and an Indian subsidiary, or Indian parent and a foreign subsidiary, ESOPs are possible and employees can participate in the ESOP as well. Akash has raised an interesting question. Can the tax on ESOPs be paid by the company? So thank you, Akash, for bringing this point up. As I mentioned, when the ESOPs are exercised by the employee, there is a tax consequence, and that tax has to be employer has an obligation to deduct and employee has an obligation to pay. Now, commercially, employer can agree to pick up the tax cost, and under the tax law, this tax can be borne by the employer. So instead of employee paying it, even the employer can pay it. A additional perquisite or tax perquisite which is there is not applicable. But more or less, let's say in a simplistic way, if I got ESOPs, if I exercised ESOPs where the fair value is, let's say, 1 crore, and if I'm required to pay tax at the rate of 30%, that 30% tax could be paid by my employer as well. There is no further tax on that 30%, which otherwise can happen in other perquisites that an employer bears. So, Akash, thank you for raising this question. The answer to your question is yes. Employer can also pay the tax, but again, commercially, first there is a tax cost and an outflow. Either a company or the employee has to bear that outflow. So often there is a dilemma or a conundrum as to, can I minimize that cash flow, because at the time of exercise there is no liquidity available either to the company or to the employer. Let me move to the next point, which is buyback of option. Now, this could be a heavy technical nuanced interpretation from a tax point of view. But before tax, let's look at the commercial angle to it. Buyback of options. I'm sure we all have heard about buyback of shares. But of late, we've seen companies also, uh, do a buyback of option. And first major buyback exercise was carried out by Flipkart. Uh, and I think there the commercial rationale was slightly different. When Flipkart tried to do a buyback, uh, Flipkart had sort of hived off one of its divisions into another company and sort of had monetized that business. So existing employees of Flipkart who were option holders, they were losing this value because of the hive off that Flipkart had done. So to compensate such option holders, Flipkart did a buyback and paid a compensation. So if I have options open, not shares, options open, which are vested in me or near vested in me, then company bought back those options or canceled those options and paid money in lieu of that, in lieu of those options. Now, from a company law standpoint, it is permissible to do a buyback of stock options. So that's point number one. Tax becomes very interesting proposition, and here, while what I understand is that Flipkart, while doing the TDS, treated it as a salary and deducted the tax. Many of the employees have gone ahead and claimed it as a capital receipt, which means that they have treated this as a non-taxable receipt. And in fact, we have a couple of high court judgments approving this particular tax position as well. So this is one sort of example in a where a buyback of option has happened. Of course, not every time a company can do a buyback, because when you're doing a buyback of options, company has to shell out the money. uh, Whether they have the money to do so is the question. Of course, in Flipkart case, they had this money with them, and therefore the buyback was carried out. So this is again one interesting tax efficient way which I have seen at least the cash rich companies are exploring, or have explored. In fact, the Swiggy news, there were two news items that I picked up last week. One is a additional ESOP to the founders, and they have also announced some buyback of options as well, so that employees get cash before the IPO and they sort of stick around longer. So buyback of options can provide some sort of tax benefits, provided, of course, there's a commercial rationale, your investors agree with it, and you have enough cash to do this share buyback. Um so, so this is a this is a sort of another interesting proposition around buyback of options that I've seen in the recent past. There are a few questions. Let me sort of deal with them. Uh, so there's a question: is there a way MNC provides ESOP? I think they reduce 30% share. So, Rajul, yes, this is a way where a listed MNC, and this is for benefit of everyone. Let me just touch upon this structure, which I have seen many US listed companies have done. Is that a US, and this is another way of SAR, stock appreciation right. What a US listed company does is that um, through a trust, this company actually buys its own shares. So the trust buys the shares in the listed company. So let's say company has given 100 options to me. They will, the trust, the ESOP trust will buy 100 shares from the market at today's price. Now, let's say after 3 years, those ESOPs vest in me and I'm entitled to the economic benefits of this ESOP. At the end of 3 years, let's say the value has gone up by from 100, it has gone to 500. So the trust is actually physically holding these shares. The value of those shares has also automatically gone up from 100 to 500. Now, what trust does is that it actually sells these shares in the market, gets the money, and it is paid to the employee like a bonus after 30% tax. So effectively, company has deducted the tax component and they will sort of pay the balance amount to the employee. So this is another way. Even some of the Indian listed companies I have seen offer ESOP through a trust route. So this is of course relevant for large companies. I have not seen this mechanism almost doesn't work for early stage startups or startups with no sort of liquid market available. Does the timing of taxation? The next question is: does the timing of taxation change if some rights vest but shares are issued on a deferred basis? So, so yes, I mean, as I mentioned. Last the second last slide on the during last session, you can defer your exercise of the shares are vested in you but employee has chosen not to exercise. This action results in a deferral of tax, surely, but then the subsequent tax of capital gains my ability goes down. Those who sort of missed last time session could look at that slide, and these slides will be shared with you after the session. So I think that will sort of give a clarity as to what changes from a tax point of view. But conceptually, yes, you can defer the actual exercise of the shares to a later point in time as well, and therefore defer the taxation. I want to sort of pause here before we deal with slide 6. Are there any more questions? I can wait for maybe half a minute in case you want to put down your questions in the chat window.
Probably more questions might come as you
Sure.
proceed.
So this is almost the last slide for my session. So if you have any more questions, feel free to type them in the chat box, and then I'll deal with this slide on stock options in case of non-companies. And you might sort of wonder and pause, why am I even talking about it? We have seen that many times new businesses today, I mean, if it is proprietary business, then surely it's a different story. You can't issue ESOP. If it is a partnership also, no employee would agree to become a partner in a regular partnership. But we have seen LLP, that is limited liability partnerships, also is a form of vehicle for doing business. And LLPs can be registered as startups with DPIIT. They are eligible for tax holidays and so on. So the question often comes is that how these ESOPs can be issued in case of limited liability partnerships where a startup is organized as a LLP. As you know, conceptually, the legal framework for companies is different. It is governed by Companies Act 2013, whereas for LLPs, the governing law is the Limited Liability Partnership Law of 2008. And fundamentally, these are sort of two different forms of carrying out the business. From a taxation point of view, of course, there is a fundamental difference between how a LLP is taxed and a company is taxed. So by nature, LLP, there is no share capital. There is a partner and there is a share of partners which is defined, and therefore issuing ESOPs becomes very, very difficult, or I'm not saying impossible, but near to near to impossible in case of LLPs. There is no separate sort of governing framework. So really, then the two approaches are possible is that you allow a employee or a non-employee to actually become a partner in the partnership firm with, and a LLP agreement could very tightly define the extent of the rights that that partner will sort of enjoy. Similar to the ESOPs, because ESOPs, because the company law framework gives a lot more flexibility, but in case of LLP, all of that flexibility or the conditionalities and restrictions have to be put in place in the LLP agreement itself. The administration again becomes very very difficult. But like I said, if there is absolutely a situation where LLP has to reward um, a employee, then this is the only way. I have seen there's a potentially higher tax cost as well. I'm not getting into the sort of nitty-gritties around it, but all I was trying to say is that in case of LLPs, uh, administering ESOPs is highly difficult and not very tax efficient as well. So if the founder is continuing LLP as a form of doing business, then there are associated downside, which is non-effective ESOP is one of the downside. Or else one can think of converting LLP into a company as well, and then issue ESOPs. So this question was actually asked by one of our client, and that made us think that is business wise or commercially, whether it is company or LLP, employer and employee both have aspirations to participate in value creation. But unfortunately, LLP does not have a equivalent ESOP regime. So we'll have to figure out a way to make them partner without all the rights of a partner or limited rights as a partner. I mean, one key fundamental point, for example, in a company, your voting right is to the extent of your share in the capital. So if a ESOP holder holds 1%, your voting right is 1% in the overall equity. But in case of LLP, unless you specify otherwise, all partners have equal voting share. So then you have to go and define, what are the voting rights available to a ESOP holder who has become an LLP partner, and things like this. So these are the additional complications which are there in case of which become relevant in case of LLPs. There's a question on ESOP buyback. What is the tax implication? So ESOP buyback by a company, there is a view that is possible that there is no tax applicable. So what? What I have seen, and Flipkart is a example where company has deducted the TDS, saying that it's salary, but employee in his personal return has taken a view that this amount is not a salary, but it's a capital receipt. It's not taxable and has claimed a refund of the TDS. And like I said, there's a favorable High Court judgment, allowing this tax position as well. So, so, so this is it, Shruti. I mean, I'm happy to take more questions, but this is what I had to share on share-based payments with all of you. I'll pause here if there are any questions.
Yeah. So before the further questions come, let me alert everyone. We have pasted the feedback link in the chat box, requesting all of you to give your feedback before you leave the session. It will help us to curate more relevant sessions, interesting sessions for you in the future also. Yeah. If there are any questions, you can either put it in the chat box, or you can also use the raise hand button which is there against your name. So we can also unmute you, and you can feel free to ask your questions yourself. Ameya, till questions are coming, do you want to touch upon any specific questions which you said that would be a little beyond the topic?
No, I mean, there is one question from Neeraj, but like I said, there are some numbers and specifications. It's I think maybe we could take it off or take it offline and not bother everyone with those heavy facts. So
Sure, not a problem. So yeah, people do avail of the feedback link meanwhile. Okay. Ameya, just requesting 2 more minutes in case there are any more questions.
yeah,
I'll
no
also
problem.
make the announcements for the upcoming sessions. Our next session, we are going to take a slight break because of the festive season in between. And we will meet again for our next session on 12th of November with a session on technology readiness levels by Dr. Hiran Vedam, who is an expert in that domain. So there are no sessions in between during the festive season, but we'll meet on Tuesday, 12th of November at 4 o'clock with the next session in this series. So yeah, I don't think there are any more questions, Ameya. Thank you so much for your time. And we hope to have you again for any more interesting topics, which we will be able to host you for our next events. Thank you once again.
Thank you to the entire Venture Center team, Mugdha, Shruti, and Dr. Premnath for the opportunity.
Thank you, Ameya.
Bye.